Okay, well, good evening, everyone, and welcome. We are very excited about today's presentation, our kickoff meeting for 2021. We have a jam-packed informational webinar, and Sam and I are going to be going through the presentation together, and let's jump right in.
All right, let me get it pulled up. Here we are.
Okay, so this, of course, is our annual 2021 economic update and investment outlook. As we go through the presentation, a couple points of mention. Number one is we are recording this presentation. We will be sending you the video as well as all the slides. That will be in your email box Monday or Tuesday of next week. You'll have something to refer back to, but in the meantime, we would strongly encourage that you make some notes and have something to refer back to even before Monday, Tuesday next week. You'll have an opportunity to ask questions, and at the bottom of the screen, there is an icon box, Q&A. You can type in your questions. You can do that anytime during the presentation. However, we're going to save time at the end of the presentation to answer all the questions. And hopefully we can answer all the questions. We did a webinar yesterday and we had a overwhelming response of questions. If we're not able to answer your question on the webinar today, we'll then follow up, and certainly you can schedule some time to visit with us. So the next slide here is the standard regulatory disclosure. This is our standard slide. Thank you, Sam. All right, so I want to introduce you, which you already should know. I'm Jordan Dechtman. Sam is joining me on this seminar, and our other esteemed wealth advisor, Adam Dechtman, is also on the call, but not on the screen. And we want you to know that you can call the three of us for anything. We all work together. We're a family business. We work as a team. And I'd be remiss if I didn't acknowledge our crack staff of 8 folks, many of you are very familiar with, and we are so proud of them. And we're here to serve you. And we are very grateful for the opportunity and the privilege, and especially for the trust you have placed in us. So our agenda here today is very simple. The presentation itself is about 50 minutes, and then we've saved about 10 minutes Q&A. So hopefully you'll be able to join us throughout the whole program. I want to say we saved the best for last, but there's great information throughout the entire presentation. So we're going to start off with an economic update of last year and a market review. We're also going to talk about the new administration, what should you expect, and how we can do some planning as such. Tremendous amount of media coverage lately has been regarding Bitcoin, GameStop, and other market mania. We're going to be addressing that as well. 2021 outlook, is now a good time to invest? You're going to want to hear that section. There are fabulous ideas, great information in that regard. And then lastly, next steps, 3 things that you need to do right now. If you're a guest, I welcome you. If you're a longtime client, again, we thank you very much. I'm going to turn over the first part of this discussion to Sam. Sam, take it away.
All right. Thank you, Jordan, for that introduction. So we're going to start first by giving a recap of 2020 from an economic and market perspective, and we're going to dive right into the gory details first. So what we're looking at here on the screen shows the US GDP by quarter going back to 2015. And on the far right-hand side, you can see that it extends through the end of 2020. So what we're drawn to here in the right-hand side of the graph is this historic decline that we saw in the first and second quarter of 2020. So in fact, the economy contracted last year at 3.5%, which is the largest decline that we've seen since just after World War II and the first that we've seen since 2009. And to just give you a few more numbers, in the first quarter, the economy was down 5% on an annual basis. In the second quarter, 31.4% on an annualized basis, a hugely historic decline that we saw, which was a result, of course, of all of the shutdowns and lockdowns that we saw as a part of trying to maintain and tame this virus. But then in the second half of the year, we saw also a pretty historic rebound. In the third quarter, 33.1% growth. And in the fourth quarter, we saw 4% growth on an annualized basis. Now, that fourth quarter number may be revised here in the next few weeks. But looking forward, the IMF, the International Monetary Fund, expects the U.S. economy to grow 5.1% this year, while economists surveyed by the Wall Street Journal project 4.3% growth. And a reason why we've seen this rebound in the second half of the year is a lot of uncertainty that clouded the market during the first scary months of the coronavirus started to dissipate. And you also started to see lockdowns begin to ease in certain areas of the country. So where are we seeing this strong growth now in this rebound? We're seeing it mainly in corporate and residential housing investments, which we believe could set us up for a potentially strong 2021. So now we're looking at employees on total non-farm payrolls. So what you're looking at is it going back from 2000 again through the end of 2020. So since the great financial crisis of 2008, 2009, the economy added 22.8 million jobs. But in February and April of 2020 alone, 22.2 million jobs were lost. So what took 10 years to have us job creation since the great financial crisis, we lost in a matter of 2 months. But since April of 2020 through present, we have since regained 12.3 million jobs. So a pretty sharp comeback. However, you can still see that there's a big difference. In fact, there's about 10 million jobs that are no longer being filled that were going into this event that we saw at the beginning of 2020. Now, we're encouraged that 2021 could be a great year for job growth. In fact, there's some analysts that are projecting that we could see upwards of 6 million new jobs added. But just looking at the math, if we have 6 million new jobs added in 2021, that still doesn't get us back to where we were. So we feel that from a labor perspective, we may not be back to the employment numbers that we were leading into the coronavirus until 2022 or quite frankly, 2023. But what we're focused on now is that we are looking to be on a better trajectory in terms of job growth instead of job losses. By several measures, U.S. stocks were some of the most volatile in history last year. Compared with other recessionary sell-offs in recent decades, 2020 marked the swiftest drop as well as the quickest, sharpest bounce back to a prior peak. The entire year was characterized by large, frequent daily price swings in both directions. In fact, 43% of the days that the market was trading, the S&P 500 moved up or down 1%. So to give you some perspective, we wanted to show you this chart. So you can see historically the average of moves of greater than up or minus, positive or down 1% is about 63. Whereas in 2020, you can see that we're well over 100, it's about 110. So we're just shy of about doubling the historical average in terms of daily moves. So if you thought 2020 was a volatile year and didn't know if you'd seen anything like it, well, in 2008, 2009, we did, but we haven't seen anything like that for an extended period of time. And while we see, some positive currents going on in the economy and the market, we still believe that 2021 is going to provide its fair share of volatility, both, up and down. So we're not out of the woods yet. The volatility, we think, is going to be here to stay until we really have widespread vaccine distribution and the economy can really get on its own legs again. So when everything was going south at the beginning of the year, what happened is the Federal Reserve cut interest rates, which is what we're seeing here on the right-hand side. And so what this graph is showing us is the path of interest rates, and specifically the federal funds rate from 2000 to 2020 and then dipping into 2021. And so you can see that as we had made the recovery from the great financial crisis, the Fed had started to lift interest rates because the economy was looking strong and being able to stand on its own legs. And of course, all these lockdowns, completely dismissed all that. So the Fed decreased interest rates to now they're near zero, if you will. So the decrease in interest rates is definitely used to help spur economic growth. It's to help encourage companies to take on debt when necessary to continue operations, to continue paying their workforce, to continue investing in research and development, to continue investing in inventory. But the decrease in interest rates probably benefited a lot of people that are listening to this webinar right now. How many of you out there refinanced your mortgage within the past year? My bet is a great number of you have. So the decrease in interest rates, can be a very positive thing in terms of helping the economy keep moving forward. So as I mentioned, with the decrease in interest rates, we saw companies take on more and more debt. So what we're looking at here is a graph of the U.S. corporate health. So it looks at the net debt of the companies in the S&P 500 from 1992 through the end of 2020. And what we're looking at in this graph, of course, is it's steadily increasing. Now, I know what some of you maybe are thinking at home. Sam, I wanted you to talk about this. I'm concerned about the growing debt of these companies, and are we going to be hitting some sort of bubble or another huge crash? Well, what we're about to look on the next slide is an overlay. So what we're seeing here at the top is the amount of debt that companies are taking on in the S&P 500, and the bottom shows the net debt divided by earnings. So what that means is how much of profits is being put towards paying off debt. And what we can see here on the far right-hand side is that the level has stayed pretty steady. And in fact, it's significantly lower than what we saw from the great financial crisis and from the dot-com bubble. So much in the same way you refinanced your home to pay a lower rate, some companies have been doing the exact same with their outstanding bonds. So they've been issuing more debt at lower rates to pay off their higher interest, bonds or securities that they had out there in the marketplace. So we're definitely keeping an eye on this debt binge, if you will, from companies and making sure that they're able to service this debt in a way that is, manageable and will keep them solvent in the ever-growing future. But at the moment, the growing level of total debt doesn't concern us because as we're looking at the earnings, they're definitely able to match that. So now let's dive a little bit deeper into earnings. Earnings, another name for them is profits. So what we're looking at here in this graph is the profits from the S&P 500 from 1988 through 2020, and then some projections, of course, in 2021 and 2022. So what I want to draw your attention to is up here on the right-hand side, these light blue bars. Now, the left blue bar shows us the estimate for what we think earnings will be in 2020. The reason it's still an estimate is some companies have yet to report, so we're not positive as to what the exact number is. But what I'll point out, and I'm sure you probably thought at home, is that earnings decreased from 2019 to 2020. So you might be thinking to yourself, okay, Sam, I hear what you're saying. The economy had a historic decrease, the first decline since 2009. We lost 10 million jobs, and I'm not sure why the stock market went up. It doesn't make any sense. It seems like they are completely separate. And quite frankly, the economy and the stock market are two completely separate things. The economic numbers that we see are always looking backward. They're looking through the rearview mirror. They tell us where we have been. The stock market is a scale, if you will, that weighs investors' anticipations for the future. So the reason why we're seeing companies continue to do well through 2020 and beyond is because they're looking at the far right-hand side of this graph. They're anticipating that these strong companies with stable balance sheets and good businesses are going to start to make more money in 2021 and beat the profits that were in 2019, and then in 2022 do even better thereafter. And so one other thing that I want to be very clear on as well is that the entire S&P 500 and the market in general did not do well last year. Leading into August, September, there were really only 6 stocks in the S&P 500 that were positive. The entire index, besides those relatively small number of stocks, was negative. But the thing about it is those 6 stocks that were doing so well represent such a large portion of the index. I'm sure you might already know the companies that I'm referring to. It's the FANGs, and I think there's a new nickname now with the M for Microsoft. But it's Facebook, Apple, Amazon, Netflix, Microsoft, Google. Those companies did fantastic, and they really helped cover up some sore spots, if you will, from the other companies in the index. So even though it was positive up until that point, it's not as if we were having all companies that are completely divorced from reality. In fact, many of them, were still down and have since, started to rebound. So where do we think we are in terms of the global business cycle? On the left-hand side shows this little kind of up and down path, if you will, shows what a normal economic cycle looks like. So up here on the left-hand side, we can see the recovery phase, then we're in expansion, then the end being in contraction. So leading the charge right now in this red circle is China. And the reason why China is leading this charge is because when they started to see massive cases in terms of coronavirus, in their country, they enforced extremely strict lockdowns. And depending on what your feelings are in terms of the data, they handled it fairly quickly on their end and have reopened their economy much more aggressively and gotten back to work and really jump-started it. So that's why we feel that China is a little bit farther along in the process, and at least the data we're getting from there would indicate as much. And then in the light green bubble, you can see here in the United States, as we saw in the first graph of this presentation, we've already seen the economy start to move back. We're seeing payrolls jump back, and we think that there is more positive momentum where we are in the recovery phase and feel that us dipping into a recession again is, while still possible, unlikely. And then following behind, you see Australia, Brazil, India, the Eurozone, UK, Canada, and then Japan, Korea, and Mexico. So those areas are certainly trailing behind the US and China, but hopefully if they can get their vaccine distribution underway and pushing forward, they will soon be joining a more solid and robust recovery. So now I'm going to turn it back over to Jordan to talk about the new administration.
Okay, thank you, Sam. So a lot of questions about the new administration and what should you expect. So let's talk about what we believe is likely and what we expect is unlikely. So I'm going to start on the left side, what we feel is likely. It's been widely stated that fiscal stimulus is going to continue. And it seems as if there's another package that's on the way, 1.9 billion. This is going to include the Paycheck Protection Program, unemployment benefits, stimulus checks, state and local aid. We see this as a very accommodative approach, not only from the federal government, but also the Federal Reserve. We think this is very likely to continue. And quite frankly, that's been a lot of the fuel that has fueled the stock market, among some other things. The second thing we feel is most likely to continue is an extension on the moratorium on evictions. So whether someone is behind on their rent or their mortgage, we feel that that will be a continuation to help them deal with the pandemic. The third item that has been uh, getting a lot of traction and getting a lot of bipartisan support is an infrastructure spending bill. We can all agree that the infrastructure in the US is deeply in need of a overhaul, whether it be roads and airports and all kinds of things. And we think this is a very positive thing for the economy. Not only will it create more jobs, but infuse capital into the economy. Next item is multilateral approach to China. Um, this has been a very challenging situation. China has their own set of challenges. We all know that. Um, but it behooves both countries to get together and come up with a deal. It's in China's best interest more than ours, but together we think it's a very positive thing if we can gain some trade agreements. Uh, we also feel most likely is climate change initiatives. And these are areas that are gaining a lot of traction in the investment community. They're also referred to as ESGs, environmental social governance. These are becoming very popular from a investment standpoint, but we feel that maybe the federal government is going to initiate some of these initiatives. On the right side of your page, unlikely policies. Now, this might be a little bit controversial, but I'm going to say corporate and individual tax increases are unlikely. Now, you might say, Jordan, we've heard all along throughout the campaign that this is a very likely scenario. We feel that right now it's not going to happen. Unemployment being as high as it is, the economy still significantly down, it would be a terrible disincentive. Now, in all fairness, we think corporate and individual tax rates will absolutely increase at some point, but we just don't feel like it's going to be this year. We would also say capital gains tax increase, the same would be true of that. We don't believe this year is going to be an increase, but hold on to your hat. At some point down the road, we're going to see that. And here at Dechtman Wealth Management, we're keeping a very close eye on that. A lot of rhetoric was mentioned about the Green New Deal. That is absolutely not going to happen due to the fact that it is a multi-trillion-dollar price tag, unrealistic, not going to happen, and we can dismiss that quite frankly. Supreme Court packing, again, a lot of campaign rhetoric, not going to happen. The idea of Supreme Court packing, the elimination of the filibuster, you still need a super majority. It's just not going to happen. And so we're keeping a close watch and making sure that if any of these do come to pass, that we're prepared and ready to make changes. So a lot is said about politics versus a sound investment principles. And we're not here to take sides politically. We are simply investment advisors trying to provide sound financial advice to you and all our clients. On this chart, it represents the various administrations going back to 1960. So this is over, or roughly now, 60 years. And if we take a look, if you had invested $1 in the S&P 500, January 1st, 1961, that same dollar would be worth approximately $500 at the end of 2020. That is a significant increase. In fact, that represents approximately a 10% rate of return over that 60-year time frame. And in fact, if we take the S&P 500 over the last 95 years, it represents the same 95%, the same 10% return. Now, over the 95 years since the S&P has been tracked, the S&P has been up positive 75% of the time. Our point here, whether it's a Republican or a Democrat in the White House, the theme is very consistent and it speaks for itself. The market goes up over time, provided you follow sound investment principles, and that's what we are here to help you with.
All right, now we're going to jump into the next section here. Bitcoin, GameStop, and market mania. So Bitcoin is a cryptocurrency that is a type of money that is completely virtual. There are no physical Bitcoins, only balances that are kept on a public ledger that everyone has transparent access to. This public ledger is called blockchain. Bitcoins are not issued or backed by any banks or governments. So why are we talking about it today? Bitcoin and other cryptocurrencies have been popping up more in the news lately, so we wanted you to be informed on our opinion. We could have a completely separate call devoted only to cryptocurrencies, so I'm going to keep my comments very high level. At this moment, Bitcoins and other cryptocurrencies are very risky, what we would call speculative investments. While someday Bitcoin may be used to purchase different products and services, at this moment there are not many things you can actually purchase with your Bitcoins. This is a nascent asset class that can experience wild swings of over 20% in a single day. If this is something that interests you and you feel you may want to invest in it, please schedule some time to talk with the three of us so we can explain if we feel that this could be a good situation for you. And so, other news stories that you might hear, of course, Tesla was in the news recently saying that they might invest some cash in Bitcoin. And they also made the comment that they might actually start accepting Bitcoin for payment for some vehicles. While we think that this is a novel concept and could be a cool idea sometime in the future, right now we feel that it's not economically viable for a company like Tesla to, quite frankly, accept Bitcoin. Because in the process of someone signing the paperwork and actually paying in Bitcoin, the price can swing so wildly, let's just say 10%. And when you're talking about the cost of a Tesla, that's thousands of dollars that can happen in a split second because of how wildly this moves. So again, this is something that you're interested in. Let's definitely schedule some time to talk. GameStop is another story that's dominated headlines over the last few months. It's a story of David versus Goliath, the little guy versus the establishment, hedge funds versus mom and pop. So what is GameStop? GameStop is a brick and mortar video game store. They sell new and used video games and consoles and other consumer electronics. Over the past 5 years, their stock has been steadily dropping and at one point was worth less than $4. That is what we call a penny stock. That was until 2021, where in a matter of weeks, the stock increased over 100 times. So why did this happen? There's an investing group on the popular internet site Reddit called Wall Street Bets. In this group, there are tens of thousands of people that are constantly suggesting different stock opportunities for other members of the group. Then one day, the idea of investing in GameStop became extremely appetizing because it meant that they could make money at the expense of hedge funds. So how does this work? Normally when you buy a stock, you hope that the price goes up. However, there were many different hedge funds that were betting that the stock price would go down in a process called short selling. So now we're looking at a diagram of how short selling works. So you can see here at the top in green, step 1 and step 2. So I'm going to walk us through a scenario so we can see how this process works. So Jim borrows shares from Alex and then sells them to Kevin. Jim, who borrowed the shares to sell, is hoping the price decreases so he can buy back the shares at a lower price so he can return them again to Alex because he doesn't own them. The difference between the price that Jim sells the shares to Kevin for and the price he must buy them back at and return them to Alex would be his profit. So you can see the difference here in where he sells it and where he would like to buy it back. This line would demonstrate the profit. Now, what happened to the hedge funds that were shorting the stock was the exact opposite of this diagram and went in the complete other direction. When a bunch of members of the Reddit group were buying shares, the prices started to go up. And this caused the hedge funds that were borrowing the shares to have to close some of their short positions. And the way you close the shares, because you're borrowing them, is you have to buy them to close that position and return them to their rightful owner. So as they are closing these positions and buying more, as tens of thousands of members of this group are, you start to see an increase in the price, which is spiraling up, called a short squeeze. This brief episode cost few hedge funds billions of dollars, made a few overnight millionaires, and undoubtedly left many individuals hurt in the process. As you can see from the wild up and down of this stock, short selling is extremely risky and not something that we ever engage in. And what you saw on the flip side from the individual investors would be described as a manic or speculative episode. GameStop, in a matter of weeks, did not become 100 times more valuable. They did not all of a sudden 100 times their profits. They did not 100 times their revenue. People were buying this stock not because they believed the value of the business was more, but because they believed that it would just continue to go up and that other people would continue to be interested. And this is the definition of a speculative investment. So this was an interesting episode that was, I'm sure, will turn into a movie at some point, or maybe a docuseries on Netflix. But ultimately, this did not have a big effect in terms of the market, and we don't see this creeping into other areas that involve your portfolios. So now let's jump into the outlook. Is now a good time to invest? So what we're looking at here on the screen is the percentage of the US population with immunity to COVID-19. And we see two different areas stacked. So the area at the bottom in the light gray is immunity from infection, and the upper purple bar is immunity from vaccination. So far, 27.7 million people in the United States have had COVID. 52.9 million doses have been administered nationally. And in fact, in Colorado, there's actually 11% of the population that has already been vaccinated. So as a result, the US has started to report its lowest number of new cases in nearly 4 months. And so what we're seeing here is this red line, if you will, is what we believe is where we could achieve herd immunity, or where we could have very significant effects from once you get enough people with immunity at that level that we should start to see cases come down pretty exponentially. And we believe that this could happen at some point, maybe early to mid to late summer. And so this is based on the expectation that the vaccine distribution will continue at a slightly slower pace than what the Biden administration had initially come out and said which was 100 million vaccinated within the first 100 days. But all signs have actually accounted to that pace picking up significantly to where we think that that could be achievable. In fact, last week, Walmart announced that they are going to be able to distribute the vaccines and become one of the largest distributors. You also see 21 other retail chains, including grocers in all 50 states. So now that we have cut through some of the red tape and some of the hurdles that were stopping the vaccinations at the beginning of the pandemic, we feel that it is really gaining steam. And in Colorado, as I mentioned, 11% are currently vaccinated, and we are in phase 1B, if you will. And so with the increase that we're seeing in immunity, we feel that a lot of positive currents are going where people are going to start to feel comfortable very soon in going out in public and resuming normal activities. And thus we feel that lockdowns should hopefully start to ease, by summertime. So if you are interested in more information on vaccines, call, and this is for our Colorado clients, call 1-877-268-2926. And here's the website as well that you can go to for other questions. And we'll be sending out this link when we send out the slides to the presentation, which will happen either later this week or early next week. But to our knowledge, phase 1B, that means any Coloradan that is age 65 or older should be able to sign up and receive a vaccine. So moving forward now, what we're looking at is the leading economic index. And this is going back from 1959 through the end of 2020. And these light gray bars, if you will, those show when recessions have occurred. So what we're trying to show you here on the right-hand side is that a recession has never occurred while the leading economic index continue to increase. And right now we're still seeing this, indicator going up, which is a very positive sign that we're hopefully not going to enter a recession in the near future. So now let's talk about how the U.S. consumer is doing. All personal income combined, which is wages and salaries, employee benefits, small business income, rents, interest, dividends, and transfer payments, was up 6.3% in 2020 versus 2019. I'm going to repeat that again because you probably thought you misheard me. All personal income combined was up 6.3% in 2020 versus 2019. Total after-tax income was up 7.2% in 2020, the most for any year since 2000. Combined, Americans saved about $2.9 trillion in 2020, more than doubling the previous record high of $1.2 trillion in 2018. And as of the third quarter of 2020, the amount Americans held in checking accounts, savings accounts, time deposits, money market funds was up $2.8 trillion from the prior year. And the last statistic I'll give you on this is about 522,000 Americans filed for bankruptcy in 2020, which was down 30% from just about 750,000 bankruptcies in 2019. So now what we're looking at here on this chart is the savings rate as a percentage of disposable income. So what you see here is a long-term average of 6.5 pre-COVID, and then you're seeing current, 12.9%. And we feel that this is an extremely encouraging sign for why we feel, as I already mentioned, the IMF and different economists in the Wall Street Journal projected that the economy could have a great year of between 4 to 5%. And the reason why we feel that way is because how many of you at home had a trip planned last year that you had to cancel? How many of you had multiple trips that you had to cancel? How about eating out? How often did you normally eat out? Once a week? Twice a week? 3 times? How often would you go to the movie theater or a sporting event? A lot of these different expenses were really put on hold, so people that continued to keep their jobs were not spending as much. And we feel that once the economy opens up, people are going to have all this pent-up demand to go and do things, take that trip that they put off, go to their local restaurant and support them, go attend the theater, go attend a basketball game, and really be active and out there once they feel safe that they're no longer going to be hurt from the coronavirus. So we're very encouraged by the fact that the consumer is doing well because the consumer represents about 68 to 70% of GDP. So if people are spending their money and working it through the system, that is really what we're going to be focused on because it's the biggest driver of what we're going to see economically. Now, government spending and inflation. So last year, through government stimulus, there was over $3 trillion that flooded the market in different ways through PPP loans, unemployment insurance, and other types of aid. Now, right now in Congress and the administration are talking about another $1.9 trillion pandemic bill, if you will. And in all likelihood, it'll pass at roughly that number or, something thereabouts. So what's going to happen when we see this huge flood of money into the economy? Are we going to expect to see inflation? So what I would say to that is let's look back at what happened in 2008, 2009, when $800 billion roughly was put into the economy as stimulus. What happened is the M2 money supply, which really talks about the velocity of money. How quickly is a dollar moving its way through the system? Never really increased since the great financial crisis. But what we've already seen so far is that this M2 supply of money, which is again the velocity, how quickly money is moving through the system, is up very significantly. And we expect with another $1.9 trillion that there should be an even higher increase in terms of this velocity of money. Now, why do we think that? Because when you have more money fighting over fewer goods and services, that's naturally going to raise the price of those goods and services. It's only natural, supply and demand. Now, we don't foresee inflation this year being a huge issue because this is something that does take time to gain steam, but it's something that we are keeping our eye on going forward and really want to make sure that we're doing our best to stay on top of inflation and guard against the, of course, insidious risks there. So what we're looking at now on this screen is a record divergence between stock and bond flows. So this is the 12-month bond flows minus stock flows. So what this means is anything above this black line shows when bond funds outpace stock funds, and that includes mutual funds and ETFs. So in the end of last year, we saw that bond funds surpassed stock funds by about $750 billion. Why is this significant? Why do we care? Well, when bond funds are greater than stock funds in terms of flows by over 250 billion or more over the next 3 years, it is generally proven to be a positive sign for stocks. And what I really attribute this to is the investor emotional cycle, if you will, where normally bull markets continue and grow on pessimism. And that's generally what you see when you see record inflows to different bond funds, and as I mentioned, savings accounts and money markets, where historically, when people are scared and run away from equities, ironically, that's where we generally see good returns thereafter. So this is another technical indicator that we're keeping our eye on that we think could present itself as positive as we continue to look forward. So where should you invest? We're going to go over a few ideas. And the first idea I throw out to you is maybe it's time to invest internationally. So what we're looking at here on the left-hand side is a valuation metric for emerging markets. Now, this middle purple line running across your screen shows the average. So whenever we're below the average, from a valuation perspective, that means that emerging market stocks are cheap, or that they're on sale, if you will. And on the right-hand side, we're looking at developed markets, where not only is it below the average, which is this middle line, it's even significantly below what we're seeing in this bottom purple line, which is one standard deviation. So while valuations are one metric that are looking like a positive opportunity for emerging markets, there's many other tailwinds that we see historically that look like they could present themselves well for the international perspective. First, when the global economy comes back from recessions, we typically see a very strong, very quick snapback from the international developed markets. Should we see inflation start to tick up, this is also something that is extremely positive for international and developed markets. And looking forward, another sign that we're keeping our eye on that is very hopeful for these two areas is the digitization of their economies. So mobile payments in China and other emerging markets, as well as developed markets outside the US, is starting to outpace the United States. And we project that going forward, that the amount of payments that are done through mobile instead of cash is going to continue to significantly outpace what's going on in the United States. So companies that are more focused and electronic and nimble and able to, move in terms of a mobile sense, we think are going to really provide attractive opportunities looking forward into the future. Another investing idea is through disruptive innovation strategies. And it's really through these 6 different themes that we feel could completely revolutionize not only if they have current industries, but completely revolutionize our economy, the way we do things, and really change our way of life. So what are they? It's artificial intelligence, autonomous vehicles, fintech, DNA sequencing, robotics, and 3D printing. All of these areas excite us because as we look through history, it's always been disruptive companies that have really changed the way that we do things. They've really changed the course of life. Just think about Amazon. How often were we buying things and receiving it same day before them? There's so many great companies throughout history that have completely shaken up the status quo, and we believe these 6 different areas could present the next frontier, could present the greatest opportunity. So this is an area that we're definitely taking a look at and would encourage, investments in these areas. But if stocks aren't your cup of tea at the moment, we suggest that bonds could be a better place for you than just cash that's sitting in a savings account. So what we're looking at right now is a diversified bond portfolio returns going from 1980 through 2020. And what you can see over the past 40 years is that it's been positive except for 3 times. So for the past 4 decades, a diversified bond portfolio has been positive all but 3 times. Now, the future may hold something different, of course, but we feel pretty strongly in our investment process and investing in high grade, intermediate to low duration bonds to provide an alternative for you because you're not earning anything in that savings account right now. Now I'm going to turn it back over to Jordan to talk about some next steps.
All right, so the next steps, the 3 things you need to do right now. A lot of information was covered and we don't want to leave you hanging. We want you to really take some action and put these ideas into practice. As we turn the corner, given the first of the year, we would suggest that you maybe take a close look at your estate plan, your will, your trust, if you will. Make sure your beneficiaries are up to date. I can't tell you how many times we've seen someone think they've updated their beneficiaries on their bank accounts, their investment accounts, their retirement accounts through work, and it was never properly updated. The second item here is to make sure that your financial power of attorney and advanced healthcare directives are in place. Very important. And if it's been a few years, something you should absolutely take a second look at. The second thing that we say you should do right now is explore investment opportunities that Sam just recently discussed. The first one is international. We feel that given the place and time we're in the market at this moment, international presents one of the absolute best opportunities we've seen in a very long time. Sam described several reasons. One other that I would like to mention is that the US only accounts for 30% of the world GDP. So what that means is there's 70% opportunity outside the US, and we have done extensive research and are able to capitalize on global opportunities. The second area Sam mentioned is disruptive innovation. We feel very strongly that growth is ultimately going to come about by innovation. And without these innovative technologies, then you're looking at the same old, same old. We feel that these opportunities, the six areas that Sam had mentioned, are unbelievably exciting and life changing as we know it. And we would love to share more and more detailed information with you in regard to that. The last item here is bank alternatives. We have found that so many people have stockpiled funds for the simple reason they're not able to do much of anything. And if you're looking for alternatives to your bank account, we do have other options that are safe, stable, and secure, liquid, and we're happy to discuss those options and see if they're right for you. And lastly, we would want to encourage you to schedule a time to visit with us. We're open for business. We're happy to meet with you in person. We can also schedule a Zoom call or even a phone call. And if you're a person that is not yet working with our firm, feel free to reach out to us. We offer a complimentary consultation. And again, we can do this over the phone or in person, and happy to chat with you. Uh, and feel free to reach out to Sam, Adam, or myself. We're here to help, and we are very grateful and appreciate your service, the opportunity to work with you, and the trust you have placed in us. Sam? Okay. So now we're going to get to the Q&A part, and it looks like we already have some questions coming in. So at the very bottom of the screen, if you do have a question, if you can type that in. Gosh, we have so many questions. We're going to try to get to all of them, but please make a note. Please just type in your question in the Q&A box, and we're happy to get to that. So let me take the first question. Um, do you see inflation being a big problem? With the government printing trillions of dollars of money, isn't this going to cause significant inflation? And how do I protect my portfolio? Well, Sam already addressed some of this already. And Sam, would you have anything else to add to that, or?
Yeah, I would just reinforce what I had said earlier in that we feel that adding the surplus of money isn't enough to really drive inflation. It's that velocity of the money, or the M2 money supply, that we really think could cause an increase, but we don't foresee it being an immediate risk, something that should immediately affect us in an adverse way. But to answer your question, how do I protect my portfolio? Well, quite frankly, if we do see an environment of increasing inflation, historically, stocks have actually proven to be the best vehicle to try and protect or guard against that.
Okay, thank you, Sam. All right, our second question is, I understand that the RMDs were waived for 2020, but do we have to take out RMDs in 2021? And the answer is yes, you have to start taking out RMDs in 2021. And that is something that we'll be working with you and continuing as you did prior if you were taking it out before 2020. So again, reach out to us, make sure that everything is set up as you want it to be set up, and we are more than happy to help you. So we have a question. Oh, someone's asking a question about the vaccine information. So as Sam mentioned, we're going to send out the link. It's going to be in the presentation recap. Hopefully we'll have it to you by early next week. Sam is more optimistic, maybe Friday, but I think Monday, Tuesday is more realistic. Um, okay, so we have a question. What's your opinion about Robinhood and similar apps? Sam, I'll
I'll,
let you.
I'll, I'll take this one. So
Thank you, Chris.
Robinhood and other what's called robo-advisors offer investments to individual investors at extremely low minimums. And what they seem to be is extremely low cost. But like we know in every part of life, there's no such thing as a free lunch. Robinhood must make money. These other robo-advisors make money. So how do they make money? Well, one way that we've discovered in recent months is that Robinhood sells order flow to other hedge funds or institutional investors. So without getting in the weeds, all you need to know is that Robinhood and other robo-advisors disadvantage their investors by giving a heads up to the big boys about where their investors are buying and selling stocks. So the hedge funds can go ahead and front run these different types of positions and take increased money there. What you also see is that if you're in these robo-advisor accounts and you're in a non-retirement account, you will see a lot of turnover, especially during volatile times, which will cause significant tax consequences exactly when you don't want it. And there really has not been proven to be any stellar performance. In fact, the studies that we've seen from the model portfolios from these specific robo-advisor firms has proven to be quite dismal. So do I think that they serve a nice place in the industry? Yes, I think that they offer affordability in a way for those without much saved to get started in investing, which I think is fantastic. But for those that have accumulated some sort of wealth, I think that there are significantly better opportunities.
Next question. Uh, do you have a diversified group or investment for an investment for investing in breakout investments, AI, etc.? Yeah, thanks, John, for the question. That is something Sam talked about a little bit about the disruptive technologies or disruptive innovation. And that is something that we absolutely have a separate strategy and an implementation. We tend not to use individual stocks per se. We are much uh, in line with institutional mutual funds or ETFs, and that can be part of an overall strategy depending on your situation. And again, we're more than happy to discuss this with you offline on a personal level. Okay, let's look at our very last question. Tony tells us or asks us, do you see a significant drop in commercial real estate due to employees working from home, reducing the need for large offices? Sam, I'll take this first if you want to add to it. So, Tony, I would say the answer to that is yeah, we do see a drop in commercial real estate. We see it changing as we've seen the economy changing. And I would answer it really in this in the fold that we focus on the sectors where we see the greatest opportunities and keep you out of harm's way. So there are certain sectors that have struggled this past year. Commercial real estate being one, as you mentioned, travel and leisure, hospitality, energy. Those are some sectors that we have underweighted for obvious reasons. The areas that we see opportunities, the disruptive technologies that was mentioned, certain healthcare sectors. So we're going to lean in and focus on opportunities where they're going to give you the greatest ultimate value in the long term. Well, I apologize. We're up at the top of the hour. We're not going to be able to take all the questions, but we would encourage you to call in, schedule an appointment. We'd love to meet with you. We're ready. We're able. We're here for you. Um, Please give us a call. Thank you again for attending. Have a wonderful evening. God bless. Bye-bye.
Thank you.